This is a recording of assignment by Professor Samuel Tong for financial and accounting and managerial accounting. This work assignment is presented by Chow, myself, for financial and managerial accounting. The topic is adjusting entries. Adjusting entries are made end of an accounting period to measure all revenues and expenses for that period. There are two types of adjustments, but in four categories. The adjustments are revenue and expenses. And for revenue, we have unearned revenue and accrued revenues. Expenses, there is prepaid expenses and accrued expenses. The three-step process for adjusting entries are: identify the type of adjustment, whether it's revenue or expense, and also to determine the amount to be adjusted, and lastly, record the adjusting journal entry and post to the appropriate accounts. In this assignment, we are to record the adjusting entries using the three-step process for a company called Morgan Marketing Company to record accounting entries year-end December 31st. There are three scenarios to the assignment. One is to estimate to record estimated electricity usage at $360 for December, but payable in January. To record the wages owed to 10 employees working 4 days at $150 per day at end December, but payable in January. And lastly, to account for the loan out of $5,000 back in September at the annual interest rate of 14%, and the principal and interest rates is receivable 1 year later in September 1st. So we'll go into the first scenario, where the estimated electricity usage is $360 for December, but payable in January. This is an accrued expense, and the amount is $360 estimated, and we term this under utilities. So in the balance sheet account, we put this as a credit for utilities payable and a debit for utilities expense. And the journal, we would represent it in this manner, where we have the date December 31st with utilities expense debit $360 and utilities payable credit $360. In the second scenario, for wages, there is wages owed to 10 employees who work for 4 days and each day at $150 at the end of December, but payable in January 2012. So this is considered an accrued expense, and the amount is $6,000, where we derive it from $150 per day multiplied by 4 days by 10 employees, and it's termed under wages. So it is a credit for wages payable and a debit for the wages expense, and this is represented in the general journal in the following manner: wage expense debit $6,000, wage payable credit $6,000. The last scenario is a loan out $5,000, but this is loan in September 1st at the interest of 14% annual interest rate. Principal and the interest receivable is due only 1 year later in 2012. So this is an accrued revenue for the amount of $233.33. And this was derived by the principal $5,000 multiplied by the annual interest rate of 14% and prorated 4 months from September to December to arrive at $233.33. So this is a debit in the interest receivable, and it's a credit for revenue and the interest income. So in the general journal, we represent it in this manner, whereby it's December 31st, and interest receivable debit, interest income credit, and this is how it's recorded. And for the references, all this is referred to at the Financial Accounting Textbook, 6th edition, by Levy and Short. Alright, so this finalized the homework assignment. Thank you very much.